Spousal Lifetime Access Trusts, SLATs, opportunity or overhyped strategy. If you've been hearing more about spousal lifetime access trusts or SLATs, you're not alone. But the real question is, are they actually as powerful as people say? To answer that, we need to start with the big picture in 2026. The federal estate, gift, and generation skipping transfer tax exemption is now approximately $15 million per person, indexed for inflation. And portability between spouses remains available when properly elected through an estate tax return. This shift has significantly changed how families approach wealth transfer planning. So while the urgency around expiring exemptions has eased compared to prior years, the planning opportunity hasn't disappeared. It has simply evolved. And that's where SLATs come in. SLAT is an irrevocable trust created by one spouse for the benefit of the other spouse and often other family members, such as children or grandchildren. The goal is to remove assets and future appreciation from the taxable estate of the gifting spouse while still allowing indirect access through the beneficiary spouse. At a high level, here's how it works. One spouse transfers assets into the trust and uses part or all of their lifetime exemption. Those assets and any future growth are generally removed from the taxable estate. The other spouse can receive discretionary distributions from the trust, which is why SLATs are often seen as a flexible estate planning strategy. In many cases, SLATs are structured as grantor trusts for income tax purposes, meaning the contributing spouse pays the income taxes on trust earnings. This allows the trust assets to potentially grow without being reduced by income taxes inside the trust, enhancing long-term wealth transfer efficiency. But SLATs are not without trade-offs. First, they are irrevocable. Once created and funded, the contributing spouse gives up direct control and cannot be a beneficiary. They also typically cannot act as trustee. That loss of control is one of the biggest emotional and practical barriers for couples. Second, access is indirect. The couple relies on distributions to the beneficiary spouse. If circumstances change, such as divorce, death, or strained relationships, that access can be reduced or lost entirely. Third, SLATs introduce complexity around reciprocal trust planning. If both spouses create trust for each other, the structures must be meaningfully different in timing or terms to avoid IRS scrutiny under the reciprocal trust doctrine. There's also the income tax consideration. Because SLATs are often grantor trusts, the contributing spouse may be responsible for paying the trust's income taxes each year. That can be a significant long-term cash flow commitment. And finally, there is the trade-off that often matters most in modern estate planning: basis step-up. Assets transferred into a SLAT generally do not receive a step-up in cost basis at death. That means when appreciated assets are eventually sold, capital gains tax may still apply. By contrast, assets held until death in a taxable estate may receive a full step-up in basis under current federal law. So the planning decision becomes a balancing act. Estate tax reduction versus capital gains tax efficiency and flexibility. From a practical standpoint in 2026, SLATs tend to be most relevant for higher net worth families who are trying to use exemption amounts while still maintaining indirect access to assets. But they are not universally appropriate. They typically work best when the following conditions are met. The couple has sufficient independent assets outside the trust. There is confidence that marital circumstances will remain stable. And long-term estate tax exposure justifies giving up control and basis step-up. In Arizona specifically, SLAT planning fits into a broader environment where there is no state estate tax, no inheritance tax, and no gift tax at the state level. That means planning is driven almost entirely by federal law and often paired with community property rules that can provide significant basis advantages at the first spouse's death when properly structured. That combination makes Arizona both powerful and technical when it comes to trust planning. Small drafting decisions can have large tax consequences. So are SLATs worth it? The honest answer is sometimes. They are not a magic solution. They are a trade-off tool designed for families who are willing to exchange control and basis flexibility for estate tax efficiency and long-term growth outside the estate. And that brings us to the real takeaway. SLATs are not about maximizing wealth alone. They're about balancing access, control, taxes, and timing in an uncertain future. Because in modern estate planning, especially in 2026, the goal is no longer just reducing taxes. It's designing flexibility into wealth that is meant to last across generations. And the families who understand that distinction are the ones who use SLATs effectively or decide not to use them at all. Because ultimately, the most important estate planning decision is not just what you transfer, it's what you're willing to give up in the process.